European stocks are making headlines, with markets across the continent close to reaching record highs. This is the fourth week in a row that European markets are on the rise. But why is this happening? Let's break it down. The main reason behind this surge is the expectation that interest rates across Europe might be coming down. In countries like France, Germany, and Spain, inflation, basically the rate at which prices for goods and services go up, has started to slow down. This is good news because when inflation is under control, central banks like the European Central Bank, or ECB, are more likely to lower interest rates. Lower interest rates mean it's cheaper to borrow money. This is great for businesses because they can borrow more easily to invest in new projects, hire more workers, and expand. For consumers, it means cheaper loans for things like homes and cars, which can boost spending and help the economy grow. We're already seeing the effects of this optimism in the markets. The Stoxx Europe 600 index, which tracks the performance of 600 large companies in Europe, has gone up by 1.4% this week, bringing it close to an all-time high. Let's take a look at some of the key market indicators. The Stoxx Europe 600 is at 467.12, up 1.4% for the week, and it's gained over 15% so far this year. The UK's FTSE 100 is up 1.1% this week and nearly 10% for the year. Germany's DAX has risen 1.5% this week, showing an impressive 18.6% increase year-to-date. France's CAC 40 and Spain's IBEX 35 are also on the rise, reflecting strong gains. In France, inflation has dropped to its lowest level since July 2021. Germany and Spain are seeing similar trends. This inflation slowdown supports the ECB's strategy to potentially cut interest rates further. For businesses, lower inflation can mean lower costs for raw materials and supplies. Imagine running a small bakery. If the cost of flour and sugar goes down, your expenses drop, making it easier to turn a profit. But the story doesn't end in Europe. Across the Atlantic, the US is also seeing market movements influenced by expectations of rate cuts. Traders are watching closely as the Federal Reserve, America's central bank, releases key economic data. Here's what's happening in the US markets. The S&P 500, a major US stock index, is up 0.2% today and has gained nearly 17% this year. The tech-heavy Nasdaq 100 has risen by 0.4% today, with an incredible 38.5% increase year-to-date. Even the Dow Jones and the Russell 2000 are showing steady gains. These movements aren't just affecting the US, they have global implications. When the US Federal Reserve hints at cutting rates, it influences markets around the world, from Europe to Asia. Let's check in on the currency markets. The euro is holding steady against the US dollar at 1.1076. The Japanese yen and British pound are also stable, with only minor changes. The Chinese yuan has edged up slightly, reflecting some optimism in Asia. Commodity markets are reacting too. Gold prices have dipped slightly as traders weigh the impact of possible rate cuts. On the other hand, oil prices are climbing, driven by strong US economic data and supply disruptions in places like Libya. The possibility of rate cuts in the US could trigger similar moves in other countries. Central banks in Asia, for example, might follow suit, lowering their own interest rates to keep their economies competitive. One key thing to watch will be the upcoming US jobs report. Economists are predicting around 170,000 new jobs added, with the unemployment rate holding steady at 3.5%. Strong job growth could support the idea of a soft landing, where the economy slows without falling into a recession. In summary, European markets are riding high on the hope of lower interest rates, driven by easing inflation. This positive momentum is mirrored globally as economies from the US to Asia react to the possibility of rate cuts. Keep an eye on these trends, they'll be shaping the markets in the weeks to come.